First red and first green days are by far one of the most lucrative trading setups that you can find on a weekly basis. But sometimes they don't go as planned. Sometimes there's a first green day that dumps down the next day and turns into a trap, or a first red day that ends up going vertical to the upside. In this video, I'm going to show you exactly how you can find more high probability first red and first green day templates so you can stop getting caught in these bad moves. So before I even explain how to not get trapped in a first red or a first green day trading template or setup, I need to explain what they are first. On this, I'm going to use A plus B equals C as my type of example because A plus B equals C, if I don't have A and B, both of those variables, then I can't have my trading day over here, which would be C. So A for a first red day is going to be the pump day. And now this could be multiple days of pump or some kind of move that blows off in a direction and leaves a larger space below price, where price currently sits, for the market to fall back down through. So over here, A large pumping day, a day that they have broken out and they've closed, they've gone vertical. Awesome. That's the first part of the equation. The second part is the peak formation day. They need to trade up through previous day's high and put in a peak formation high, or they just need to have a peak formation high that has formed between your pumping day and this day right here. So let's say, for example, this A day blows off in a direction and puts in a peak formation high on this day, and then this day turns into an inside day, but they still trade up first, put in peaks, and then down, closing below the open for that day. This could be your pumping day, an inside day, first red day, and then your trading day. That's not what we have here in this example, but that is one variation to look for. So on this example, you have your pump day. I'm going to refer to that as A. And then you have B, which is your second day of the template, the peak formation day. They put in this larger M, and then they broke down and closed below the opening price for the day. On the following day, this is C. A plus B equals C. This is the day that I'm actually looking to take my trade. Depending on the previous day's template, this day could be 3 levels of rise. This day could be a rectangle, which is what we have here. Or they could have a breakout pullback template for me to get in after a lower low has been put in place. So for this one, you have the rectangle and a high of day sell, and then the breakout pullback. So depending on the time or the session that you are trading, breakout pullback for the entry, short continuation on that day. Let's dissect that previous template a little bit further. Let's deep dive into it a little bit more so we can start to understand where the good first red days come from. Let's start from the left going towards the right, kind of like reading a book. Over on this last Friday, they put in a peak formation at the low of the current week, below previous day's low, and then closed. This could have been a first green day. Regardless, this is a day one of the 3-day cycle. We're not going to really worry about that. I just want to point out that there is trap volume now down over here, and that is our peak formation day. And this gives us our first level of rise, or our first push in the upwards direction. Now, these pushes mean absolutely nothing unless we get onto that third day of rise or that third push of rise and then get a peak formation high, peak formation low below previous day's low, peak formation high above previous day's high. Let's get back into the middle. So from this peak formation, we now have 3 levels of rise just using the 100 pip box. And you can see that by the 100 pip box, right? This is the 75 level. This is double zeros. So 1, 2, 3. 3 levels of rise, and then they put in the peak formation high. All right, so now we have our second pumping day, or a pumping day in general. They've gone vertical on that second push to the high, and then on the next day, we have that third push to the high. Remember I said that third push means absolutely nothing unless they put in this peak formation high. So the behavior of the setup is starting to develop. It's starting to progress and build a good template. Peak formation high that has also made a lower low back down on the inside. There's a high, there's a low, there's a higher high, there's a lower low, and then a close below the open for that day. So we're in our third level of rise. We have a lower low back down on the inside of this week's current range. And then on the next day, we are looking for one of the different scenarios. Like I said, either 3 levels of rise or 3 sessions of rise back up for a high of day sell, or a rectangle, which is the example that we have here. A rectangle of volume, end of day consolidation, which is the last swing low and the last swing high. End of day consolidation is the last swing low and the last swing high of that day. So they have built this rectangle and they've traded back up once, twice, and a third time, breaking out, and a breakout that has now failed outside of this rectangle before breaking down. So now we have broke back down on the inside of the EMA, and depending on your trading session, this is kind of the opportunity for you to start looking to enter either at the high of the day or once it's broken down, looking for a breakout or breaking down, pulling back for the short continuation, or even once they have broke out of the rectangle to the downside, break out, pull back, again, looking for a pullback entry for a continuation of that first red day. Ideally, we want to get in up towards the top, but as the market continues to break down and fall, we are still looking for pullback entries for the range expansion of this consolidation to the downside. We're in level 3. We have 3 levels of rise. We're coming off the high of the week. We want to be targeting towards down at the low of the week, the current week. Either the low of, Tuesday, maybe the low of Monday, something like that, which eventually they do get down to the low of Monday on that following day. Now, this slide might look a little bit hectic, but if you've been following along in my live trading sessions, you saw me describe this exact scenario forming and building over the last week. So from last week, or on this example here, right, we had Thursday, they put in a peak formation high and low. This was an outside day, outside of previous day's high and outside of previous day's low. That is a peak formation high and a peak formation low. This is also the high and the low of the previous week. And if you notice, just looking at the 100 pip box, and I know it looks kind of hectic and a little bit crazy, I'm going to try and explain it or break it down from left to right. The peak formation high was made above double zeros over here, and the peak formation low was made below double zeros down here. And that is a 300 pip range in the middle of that box. So if we're looking for some kind of first red day template to form, or if we are observing this template and we see a first red day form, that can be a part of our thesis as why that first red day might be a better quality setup. So let's take a look at the week's current range. This dotted red line is the beginning of the week, and you can see I have my days down at the bottom: Monday, Tuesday, Wednesday, Thursday, and Friday. So on Monday, that is the opening range. There was a breakout to the upside. That is the first day of breakouts on this current week. And on the second day of breakouts to the upside, they've closed just outside of the range and broke down on the following day. Now, if we go back up here, look at some of the considerations for if I think this could be a better first red day template. Notice the structure. Did that first red day behavior make a lower low? So we have a large pumping day. We have multiple days of large pumping days where they are lifting price back up into the top of a 300 pip box, or more specifically, to the high of this particular 100 pip box, and then breaking back down outside of this 100 pip box, and then closing down here. All right, so we have multiple days of large lifting price up into the high, a peak formation high day. So large lifting price, pump day, A, plus B, peak formation day, equals C, right? So now we have our first red day that is now closed. So the peak formation day came on the earlier day, so the day before. And then we have our first red day behavior, so A plus B equals C, right? So that's why I'm saying don't get confused, because the pumping day actually occurred over here. Then we have a kind of a pause and a peak formation day. Then we get our first red day. So we can look for our trade over here. Now, they've pumped it up off of the low of the week. Again, 300 pip box. We're at the high of this current 100 pip box, and look at how the price has behaved coming off of the low of the day. Peak formation at the low at 25. They've pumped it up to the high of a 100 pip box in a burst, and a burst, and then a burst. And then they engulfed that upper portion of that box. Can't see exactly what time that is, but in the 12 candle window, putting in a peak formation high at the high of the current day, giving us 3 levels of rise on the day itself at the high of a 100 pip box in a potentially down moving market. First day of breakouts to the downside, first red day, for the 3 levels of rise, peak formation high, high of day sell, back down to and through the low of the day. We can look at that a little bit close, a little bit closer now. Exactly what I was just referring to on the day for this template right here. So if you're looking for this trade with that thesis in mind, peak formation was made at 25, and then that gave us 3 levels of rise back to the high of a 100 pip box, putting us at double zeros. So we would be looking for a peak formation to be put in place above double zeros, which of course does happen. It breaks back down and then pulls back into the bottom side of that EMA, or just pullbacks in general. Lower low, pullback 1, 2, 3. Peak formation was put in place. There was news on this day for the continuation down through the low of the day. And then looking at those entries on a 1-minute chart, excuse me, the lower low and the pullback. This was a trade that I did actually take on the live stream. This is the news candle right here, 10 o'clock's open, and they traded back up 1, 2, and a bit of a 1, 2, 3 engulfment. They engulfed 10 o'clock's open. That was the entry for the continuation back down. Lower lows, lower highs, news candle, 1, 2, 3 back up without making a higher high, engulfment back down to the downside for the entry short. And just to hammer home one last time to make sure everybody truly understands what a good first red day looks like, or some of the criteria that we should be searching for. Large pumping day, a day that puts in a peak formation, 3 levels of rise. Price action, looking for those push patterns, 1, 2, and 3, ending in a 1, 2, 3 in an engulfment to the high. At the high of the current week, breaking down, making a lower low, and closing below the opening price for the day. Looking for that trade on the following day. A plus B equals C. So end of day consolidation is a little bit cloudy. However, we do have high of day level from the Asian session, trades back up into that, puts in a peak formation high in the London session, and continues to break down through the New York session, back down towards where that pump began. Broke down, went vertical in the New York session, which is great, and then eventually on the following day made it back down to where that pump began. 3 levels of rise, a large pumping day at the high of the week, breaks down, makes a lower low, sideways consolidation, triggering previous day's low, and then the vertical follow through down to where that pump began. Some other things that I want to point out on both of these examples, the pound and the NASDAQ, there are 3 weeks of breakouts to the upside, 3 weeks of rise, basically displaying a overextended market, and then winding up with 2 to 3 days of breakouts on this week's template. 3 weeks of breakouts, ending in 2 to 3 days of breakouts to the upside, and a first red day. An overextended market that now gives us a first red day presentation. Those are going to typically be a lot more reliable to me than something that has been going down for 2 to 3 weeks and then gives me a first red day. Yes, the market might be in that first week of breakouts to the downside, pumps back up, gives me a first red day. Fantastic. Now I have a first red day continuation trade or trend trade. But if I'm 3 or 4 weeks down and I get a first red day, the likelihood of a dump into the low of the week for a first green day, which would be a lot better opportunity, I am usually going to look for markets that are far overextended to the upside for a first red day, or to the downside, multiple weeks of breakouts to the downside for a first green day. I have found that those templates typically will work out a lot better. And of course, presentation of the week and how the week is set up is going to give me my opportunity. And of course, first green days are everything that I just talked about with the first red day, and just flip the chart over. All right. So we would have a peak formation low day that is closed above the open, a large dumping day, first green day behavior, and then a trade day on the following day. But how do you actually avoid the false signals? I talked about it a little bit earlier about 2 to 3 weeks of breakouts in a direction and then getting a first red day, or 2 to 3 weeks of downwards direction and then getting a first green day, or even waiting for 2 to 3 weeks in the downwards direction for the market to trigger previous week's high and dump back down into the low and then giving a first green day. That break to the previous week's high could be the break in structure. The dump back down could be the dump. The first green day could begin the beginning of the pump. That part's really important, so I'm going to actually say it again. If we have 2 to 3 weeks of breakouts to the downside, the first time they trigger previous week's high could be the break in structure on a higher time frame, leading to a large dump back down into the low. That large dump back down into the low could be the beginning of the dump for the pump. Dumping back down, that could be the beginning of the template. Then we get a first green day, and then we have the pump on the other side of that move. Same thing in the long direction. 2 to 3 weeks of breakouts to the upside. The first week that they trigger the previous week's low could be the break in structure to the downside. And then that starts the 3 levels back up, giving us maybe 3 days of breakouts back up to the upside, resulting in a first red day, and then a first red day trade. Those typically are going to be much better templates. So looking at this, we want some different presentations of price. We really like stair-stepping patterns, or at least I do, right? Peak formation lows, 3 levels, looking at the stair-step, and stair-step. But the thing is, whenever you have the weekly templates setting up in a certain way, there are some very good indications that we might be getting a strong reversal. Like I just said, a peak formation or a previous week's high has been triggered and they've dumped it back down and now they're starting to march back up. Opening range breakouts, so Monday and Friday. Monday creates a range. If we break out of that significantly and we pull back on Thursday to the top of that opening range, we might be in a Wednesday, Thursday, Friday breakout pullback template. And that is definitely something you need to be paying attention to. Those levels are very important throughout the week. Opening range breakout that results in a 3 push pattern back down into the low and a consolidation above that opening range or Friday's high. If we have a previous week's high that has been broken out of, again, the market only does 3 things, something that Stacey Burke talks about all the time. Only 3 things markets do is breakout, pullback trend, breakout reverse, or stay inside of a trading range, which if we have a previous week's high that has been broken out of and they pull back in 3 pushes Wednesday, Thursday, Friday, we might be looking at breakout pullback style of template. And then your only job is to look at where is the lower rectangle. This is a breakout and a peak formation day that turned into a first red day, but then it breaks down and goes into a rectangular consolidation on top of that previous week's high, makes a higher high, pulls back, and continues. We are now making higher highs and higher lows coming out of a rectangle. That is a sign of range expansion to the upside. Parabolic trend trade back up through the high and turning into a range expansion of the breakout pullback trend continuation day. So what I'm trying to reiterate to you is as the weekly template develops, think about what I said about the weeks of breakouts, triggering certain levels. The opening range. Do we have an opening range breakout? Where is the volume currently trapped? Opening range. They attempted to go lower. There's a peak formation that has now been formed at the low of the week. We have volume trapped below Friday's low. Monday was a breakout. Tuesday succeeded as a reversal day, so first green day. Day 1 of the 3-day cycle. Day 2 of the 3-day cycle. First green day trade. First green day trade breaks out of the previous week's high and pulls back. All right, so make sure you're watching these levels. Make sure you're watching the rectangular consolidations on that Friday for the parabolic trend continuation. Instead of getting caught thinking this is first red day, I'm just going to sell the high when it is very obviously not set up for that. So taking a deeper dive into that template that we just looked at, peak formation high was made in Asia from Thursday, and that started the march back down. All right, so peak formation high, 3 levels of drop, and that gives us 3 levels of 50, and now you can more clearly see the rectangle down low. Peak formation low was made, so peak formation high, peak formation low, 3 levels of drop, and then they break back up to the upside on this day, the day that you're looking for the first red day trade, and start making higher highs, pulling back, consolidating, and going long. So this is a day where they are trapping shorts and going long. Breakout pullback, only 3 things markets do, goes back into consolidation for the vertical move. And going into the second hour, so 9 o'clock opens up, goes vertical. That was the trade. Breakout pullback back through the high of the week and beyond. Breakout once again. Breakout of previous day's high, pulls back in 3 pushes, creates a new peak formation low, locking in the previous day's low, the previous day's high, on top of the EMA for the vertical trend continuation once again. We are in range expansion mode, opening range breakouts. Another scenario of knowing when to quit, knowing when to stop looking for that first green day. When is it not the most perfect first green day template that you've ever seen, and maybe just staying out because it wasn't perfect? For example, we have a opening range that is closed in breakout. All right, they close outside of Friday's range, breakout, and then the pullback. This is an inside day, but this gives us our opening range high and a low of the week, essentially, right? So breakout, pullback, and then they go back into consolidation at the previous day's low, which is also the low of that inside bar. So any of the inside bar traders who are trying to trade the reversal on basically on a daily chart, they are now going to be caught potentially at the low of that consolidation. And you can see the rectangle. Look at the box of consolidation that is formed and the peak formation that is formed on this day. This is a first green day and an opening range breakout to the upside, which could be a carry trade or whatever you want to call it. Steve Mauro talks about these, the follow-through trades on the following day. Stacey Burke also talks about them. When they close at their highs like this, you can expect, or maybe expect, a vertical move in Asia the next day, which is exactly what happens here, blowing outside of the previous week's high. All that's great. I know I just said a lot of words. I speak really fast. I'm sorry. Maybe put it in 0.5, replay speed. But the point I'm trying to get across with this slide is, if they have already blown off in a direction, and look at this, the 3 levels of rise outside of a breakout level, and I'm trying to go long up here, does that really make sense? Is that the best first green day template you have ever seen? I would argue absolutely not, because they've just gone vertical. And the whole style of trading like this is to look for a dump so that we can get in either on a pullback for low-hanging fruit trend continuation, or a dump into the low of the week, peak formation low, for the explosion to the upside, dump for a pump. Getting in long after it's gone vertical is not a trading setup, in my opinion. So this is a good opportunity to just say, hey, the trade already happened in Asia and London. They've started to break back down. No reason for me to just try and, buy down here or sell up here or whatever. That's not the setup that I'm looking for anymore. And in reality, you can start to adapt your thesis based off of what day of the week it is and what has happened on that day. 3 sessions outside of a breakout on day 3, Friday, is a trading setup for me, especially if they start to break down and make lower lows back down on the inside of that day's range. So we're still looking at this right here. Notice this is where the day opened. Asia, everything is on the outside of that previous day's range. So now we're looking at that day in the New York session, 3 sessions of breakout, higher high, lower low. So the dump and then the pump back up into the high, we've broken back down, lower low, pumps back up 3 levels, goes back into consolidation. For the short trade, back down after 3 sessions of breakout and a lower low back down. I want to be selling at the high of the 100 pip box if I'm taking this trade at all. But it's a very quick and easy 50, 75. And a lot of times when you have 3 sessions of breakouts at the high of the week, this will usually go back down to previous day's high. Or if you're at the low of the week and you have 3 sessions of breakouts on day 3 and a higher high, a lot of times it'll go back to, at a minimum, the previous day's low. In summary, how to avoid bad signal days. This is a good one to just pause this or download this so that way you can review it and go find these templates on your own. These are all of the checklist things you should be checking for to ensure that you're not in a breakout pullback style of template. If they break out to the downside, it could be a pullback for a continuation. You think, hey, this is a first green day, and then all of a sudden it just keeps going and you're like, oh my gosh, what happened? Presentation of price on the day after you get your first red or first green day. If I get a first green day, I really like to see 3 levels of drop from the previous day's high or from the high of the day down for a low of day buy. First red day, I really like to see the pump up, the different styles of scenarios. So like I said earlier, at the beginning of this, if I have a rectangle consolidation, that's one style. If I have a peak formation at 3 levels of rise, that is one style. If I have 3 levels or 3 sessions of rise in a stair-stepping fashion, 1, 2, and 3, that is one of the ways that I like to see after first red day. However, if the time of day, it's 9:30, 10 o'clock, and we're just continuing to break out of rectangles to the upside, yeah, I'm probably in the wrong template, and I just need to move on so I don't just take a trade because I'm at the high trying to go short. No, absolutely not. You want to see a well-developed peak formation high breaks down, peak formation low starts to pump up. I am looking for the signs and the symptoms that I am correct about the setup. Just because I have a signal does not mean I have a setup. The signal is to look for the setup on the following day. The presentations of price and the time of day are what are going to give me the setup, whether or not I actually have a peak formation high after a first red day at the high of the day and it starts to break down at 9:30. That to me is a good quality setup. Videos like this every single week where I build these slideshows and they're there for your own download for free. Again, down in the description below. I hope you'll have a great weekend, and I will see you in the next one.